Hey everyone, welcome to the first episode of It's the Economy, Stupid, where we break down the week's biggest macro stories, minus the jargon, in a way that's easy to understand. I'm Kashish, and if you follow our Hindi channel, you know we love talking about macro data over there. But we figured, why keep the fun to just one side? So here I am, bringing you the same insights on the English channel. Because why should you miss out? We'll walk you through the key data points from this week in a quick, snackable bits. And if you'd rather read about it, we've got it all neatly wrapped up on our blog too. Here's what on the menu today. Number one, the rupee. What's really happening and why it's in the headline. Number two, inflation. You know how much we at Zerodha love talking about this number. Number three, trade numbers. Imports and exports are telling a curious story, and we'll unpack it for you. Number four, China's GDP update. Things are cooling down in the world's second largest economy, and it's making waves globally. If you've been even casually following macro news, you've probably seen the headlines. Rupee crosses 84 against the dollar for the first time. Big deal, right? The rupee has hit a new all-time low. But wait, how can something be at its lowest when the number you're seeing is the highest it's ever been? Yeah, it sounds like an oxymoron, but it's not. Here's the thing. When the rupee dollar number on your screen goes up, it means you now need more rupees to buy a dollar. That's because the value of the rupee has actually gone down. In simpler terms, the rupee lost some of its purchasing power. It takes more rupees to exchange for just $1. Think of it this way. There's so much supply of rupee in the market relative to the dollar that people are okay with paying more rupees to get their hands on those few scarce dollars. And that's what the economists call rupee depreciation, when rupee's value weakens and you need more of it to buy the same amount of foreign currency. So the rupee has depreciated to its lowest level ever. Bad news, right? Well, not exactly. Instead of just focusing on the absolute value, let's zoom out and look at the longer term trend to understand what's really happening. If you plot the rupee against the dollar over time, you notice the line trending up towards the top right of the chart. But if you zoom in a bit, you'll see something interesting. The line is getting less squiggly and is slowly flattening. What does this mean? This means that rupee has actually become more stable against the dollar. It doesn't swing wildly like it used to. Even with the recent spike above 84, the rupee has depreciated by less than a percent over the last year. On a 2-year basis, the depreciation is under 2%. Now, here's why this is a big deal. Over the past 2 decades, the median 2-year depreciation of the rupee was around 7%. This trend of reduced depreciation didn't happen overnight. Back in January, Commerce and Industry Minister Piyush Goyal pointed out that the rupee's depreciation rate, which used to hover between 3 to 3.5% annually, has now slowed down to 1.5% per year. He even suggested that by the end of the next decade, maybe, the rupee could depreciate by as little as 0.5 to 0.75% per year and might even start appreciating against the dollar. However, while the rupee is still holding steady against the dollar, it's struggling elsewhere. Over the past year, the India Data Hub INR Index, which measures the rupee's performance against 5 major currencies, that's USD, Euro, GBP, JPY, and CNY, has fallen by almost 3%. The real concern, a 5% depreciation against the Chinese yuan. This matters because when the rupee weakens against the yuan, imports from China become more expensive. And given that China is India's largest trading partner with $85 billion trade deficit last year, a weaker rupee could make imported goods more costly, fueling inflation. Next up, inflation. CPI inflation jumped from 3.65% in August to 5.5% in September, with food inflation taking most of the blame. While a part of this spike can be attributed to the base effect, industry veterans and government officials point to a sharp increase in fresh vegetable prices as the main culprit here. You see, heavy rains and supply disruptions drove the prices of essentials like tomatoes and onions up by 35.9% compared to the previous month. As a result, food inflation went from 5.3% in August to 8.4% in September. Meanwhile, core CPI, which excludes food prices, remained largely stable. However, with rupee weakening, particularly against the Chinese yuan, as we discussed in the previous story, there's growing concern that core inflation could gradually move higher in the coming months. The inflation story abroad isn't very different too. Globally, inflation has been trending downwards in recent months. In the euro area, HICP inflation, the eurozone's version of CPI, fell to a 41-month low of 1.7% in September, dipping below the ECB's or European Central Bank's 2% medium-term target. In response, the ECB cut its policy rate by 25 basis points. The UK also saw inflation ease, dropping to 1.7% in September from 2.2% in August, its lowest level since April 2021. Similarly, Japan and China reported a slowdown in inflation during September. As inflation cools worldwide, central banks are adjusting their interest rates accordingly, except India. The RBI chief remains cautious, stating that cutting rates now would be slightly premature. Although inflation is expected to ease in the coming months, the central bank will only consider rate cuts once it is confident that inflation will stay within the target range and not just dip temporarily. For now, the RBI is committed to a wait and watch strategy, avoiding any preemptive action. Now, for the third story, the trade numbers converged this month. India's goods trades is painting an interesting picture. Import growth has been slowing for the third month in a row, dropping from 7.4% in July to 3.3% in August and now just 1.6% in September. Exports too are sluggish, increasing by only 0.5% in September. However, this is an improvement from the 9% drop in August and 1.5% decline in July. Key factor behind recent moderation in exports is sharp fall in petroleum exports, which dropped by 25% year on year in September. Interestingly, if we exclude petroleum exports, total exports actually grew by 7%, highlighting just how significant petroleum products are to India's overall export basket. So, if petroleum is dragging down growth, what's driving exports? For the past few years, electronic goods have been the fastest growing export category. However, even this segment has lost some steam, with growth slowing to 8% year on year in September, following a 7% growth in August. Meanwhile, exports of engineering goods, textiles, plastics, and chemicals grew at a much faster pace than electronics in September. This combination of slower import growth and modest recovery in exports has shrunk the trade deficit significantly from $30 billion in August. It fell by over 30% to $21 billion in September. Finally, I have an update on China. China, once one of the world's fastest growing economies, is now facing tough times, and it seems like its days of rapid expansion are behind it. The GDP numbers reflect this shift, with the economy growing by 4.6% year on year in September quarter, a 5 quarter low. For perspective, from 1992 to 2019, China's economy consistently grew at an average rate of easily over 6% per year. But since then, and particularly after the disruptions caused by COVID 19, the Chinese economy has been hit by one setback after another. The latest and perhaps the most damaging blow is the ongoing slump in the real estate sector, which has become the biggest drag on its growth. Real estate sector has contracted for 3 consecutive quarters, with everything from sales to new constructions are on the decline and inventories have been piling up. Given that the sector accounts for nearly 20% of China's economic activity, its downturn is having significant impact on country's overall GDP growth. And that's it for the first edition of It's the Economy Stupid. See you in the next one.